Welcome back to the Explainer. Today we are tearing down, literally and figuratively, a highly technical but absolutely crucial accounting standard, IFRIC 1. I know you're here to get straight to the core logic, so our objective today is simple. We are going to completely demystify exactly how to account for the effect of changes in the measurement of existing decommissioning, restoration, and similar liabilities. Basically, we're building a practical, rock-solid mental map of how these constantly shifting cleanup estimates flow through your financial statements. Let's get into it. Here is our topic guide for today. We've got 6 key areas: scope and fundamentals, measurement change triggers, the cost model application, the revaluation model application, impairment testing rules, and finally, presentation and disclosure. Section 1, Scope and Fundamentals. To really understand the scope here, we have to start at initial recognition. The rule is, if you install an item of property, plant, and equipment, then you must recognize a decommissioning liability. The initial measurement basis is just the present value of that expected cleanup. So what's included in this measurement? Included is that present value estimate. Think of the massive future cost to dismantle an offshore oil rig. But what's excluded? Excluded are any obligations that arise simply from producing inventory. So initially, you're capitalizing that estimated cleanup costs right into the base cost of the asset itself. But here's the reality, right? 20 or 30 years is a really long time. Labor costs skyrocket, environmental regulations get way tighter, inflation does its thing. That initial estimate you made, it's almost guaranteed to be wrong. So what happens when these cost estimates inevitably change? Well, that is exactly the issue IFRIC 1 steps in to solve. Section 2, Measurement Change Triggers. You must recognize a remeasurement when any of the following criteria are met. It's a simple checklist. 1. If there is a change in the estimated outflow of resources, then you remeasure. 2. If there is a change in the current market-based discount rate, then you remeasure. And 3. If there is an increase reflecting the passage of time. Now keep that third trigger in mind, because there's a very specific exception for how we handle the passage of time, which we'll cover in just a bit. Section 3, Cost Model Application. This is the absolute core of IFRIC 1. How you treat these changes depends entirely on your initial policy choice for the underlying asset. It's a fork in the road. If you chose the cost model, a change in the liability directly adjusts the asset's cost. But if you made the policy choice to use the revaluation model, that change alters your revaluation surplus. Let's drill down into the strict rules for the cost model first. Okay, under the policy choice of the cost model, here is your if-then-where framework. If the liability decreases, then you deduct that amount. Where does it go? Straight from the cost of the asset on the balance sheet. But wait, if that decrease actually exceeds the carrying amount of the asset, then what? Well, you obviously can't reduce an asset below 0, so where does that excess go? It's recognized immediately in profit and loss. Conversely, if the liability increases, then you add the increase, where? Directly to the asset cost, which of course is going to increase your future depreciation expense. Section 4, Reevaluation Model Application. Now, let's look at the other path. Under the policy choice of the revaluation model, things get a bit more layered. If the liability decreases, then you recognize the gain. Where? In other comprehensive income, or OCI, which increases the revaluation surplus in equity. Unless, and this is a big unless you are reversing a previous revaluation deficit on that exact same asset. If that's the case, then you recognize the decrease in P&L. Plus, if the decrease exceeds the carrying amount that would have been recognized under the cost model, then that excess also goes straight to P&L. What about the flip side? What if the cleanup estimate shoots up? Well, if the liability increases, then you recognize that hit immediately. Where? In profit and loss. Unless a credit balance already exists in the revaluation surplus for that specific asset. Then you recognize it in OCI to reduce that equity buffer before it ever touches your net income. Here's something absolutely crucial. If you use the revaluation model, a significant liability change is a massive red flag. It triggers a major estimation uncertainty. The standard explicitly requires you to use professional judgment here to ensure the asset's carrying amount doesn't materially differ from its fair value. This variability is driven entirely by whether that liability shift knocked your asset out of line with current market valuations. And remember, if this triggers a revaluation, you've got to revalue that entire class of assets. Section 5, Impairment Testing Rules. This naturally brings us to a direct interaction with another standard, IFRC 36, Impairment of Assets. IFRIC 1 essentially hands the baton over to IAS 36 here. Step 1. IFRIC 1 adds that increased liability to the asset cost. Step 2. You must use professional judgment to consider if this addition is an indicator that the new carrying amount is not fully recoverable. Step 3. If it is an indicator, IAS 36 takes total precedence, and you must formally test for impairment and account for any loss. Section 6. Presentation and Disclosure. Let's talk transparency. Under IAS 1, your quantitative disclosures require you to clearly break down each component of OCI. Qualitatively, if your revaluation surplus changes specifically because of a liability estimate, then you must separately identify and describe that exact change. The users of your financial statements need the context that equity shifted because a cleanup estimate changed, not because the market value of the asset suddenly went up. All right, we need to highlight a very common application error here. It's a classic mistake: conflating the unwinding of a discount with an actual change in cash flow estimates. So here is the hard rule: except when the liability increases purely because of the passage of time. Look, as you get closer to the actual decommissioning date, that present value discount unwinds naturally. You shall not adjust the asset cost for this unwinding. Instead, that specific piece is recognized immediately as a finance cost in P&L. Mixing these two things up will absolutely distort your asset values. To wrap up the strict logic of IFRIC 1, I want us to look at this quote derived from the conceptual framework of IAS 12. It is inherent in the recognition of an asset or liability that the reporting entity expects to recover or settle the carrying amount. IFRIC 1 exists because accounting demands that the cost of an asset reflects the total economic reality of owning it, from the moment you build it right down to the moment you pay to tear it down. If the cost of tearing it down changes, the economic reality of the asset has changed. Your balance sheet has to reflect that updated reality. So, I'm going to leave you with a final provocative question to take back to your teams. When your engineers hand you an updated cost estimate for a site restoration, does your entity accurately map the downstream impacts of that changing estimate? Do you seamlessly trace it through the asset cost, trigger the necessary impairment tests under IAS 36, and correctly separate out that unwinding discount? Because mastering IFRIC 1 isn't just about moving a liability around. It is about safeguarding the total integrity of your balance sheet. Thanks for joining me for this explainer. Keep learning, stay focused, and I'll see you on the next one.